Alison, welcome to the Sophisticated Fiduciary update for the month of November.
November,
Wow,
I can't believe it.
Yeah, right? It's crazy. I mean, it just seems like, for those of you viewing, we just had our first snow already. It's crazy. It's too early for this stuff, but there's a lot going on this month, and I'm excited to have you share with the viewers all the things that are happening. We've had kind of a flip-flop in terms of the retirement provisions relating to the Build Back Better bill that's being proposed, and we've got the new IRS limits that we're going to talk about, and then we've got a study this month that we'd like you to give a preview on. Then if the viewers want to go deeper, we're going to have a deep dive at the end of this program. So let's start off with the quick hits on the headlines. Take us through, first of all, the provisions in the Build Back Better Act that are being proposed.
Easy for you to say, right?
Yes.
No, it's been definitely a lot of shifts on the legislative front. We've been talking throughout the year about our expectation that we will have some legislative action. We've really moved at this point in the year from what we want to get done to what has to get done, and all of the focus right now seems to be on the Build Back Better Act. We talked a little bit last month about provisions that were in that act. They were taken out of that bill and then added back about a week later. So if you saw headlines about those being removed, as we sit here today, I think it's November 12th, they are still in the bill. They could be out tomorrow, but right now, looking at some provisions, the biggest things that are in the bill are adding an income restriction on Roth contributions and Roth conversions within 401k plans. They've added a slightly later effective date. I think right now it's proposed for 2023 or later. So that's shifting as well to try to get a little more flexibility.
And what is that going to look like? What's that proposed to look
Yeah,
like?
the current proposal would actually have it be a little bit staggered based on filing status, whether it's single, married, et cetera, but starts around the $400,000 up to $450,000 in income. Probably don't need to get into it today because we're still really hoping it doesn't happen, but administratively would be super complicated to actually have that happen. Similarly, on eliminating Roth conversions for this population, of being able to identify and restrict those conversions from happening.
Yeah, there might be a rush to do conversions at the end of the year
Yeah, we'll see.
if that passes.
Probably the provision that would be most impactful is the idea of kind of closing the loophole for the mega backdoor Roth, the idea of converting after-tax balances to Roth balances. That would be disallowed completely. So closing that loophole in that way. I think the provision that's maybe more likely to stick, I'll say, but also perhaps the most controversial is this idea of the new large balance required minimum distribution. Will be the requirement for those that have aggregate balances in qualified plans exceeding $10 million to have distributions in the next year. That's definitely getting a lot of negative reception, but ultimately probably the provision here that would have, I'll call it the biggest bang for the buck, impact the fewest number of people, but raise the most revenue.
Yeah, it seems like, what do you think the number of people are that have aggregate balances over $10 million? Probably super small, right?
Yeah, it's probably more heads than we think it is, but ultimately not a large number of people. We've racked our brains trying to think of the single largest balance I've ever seen in a 401k plan. I think I've seen a $2 million balance. Now, of course, this would look across plans, not just at one single plan, but
Right.
can't imagine that there's a lot of them out there. And I think the hunch is a lot of those people have that money in a Roth or in an IRA, Roth or traditional IRA, that they've accumulated balances within plans, rolled them over time, are doing some, I'll say, funky things from an investment perspective or from a growth perspective
Right.
in the IRA. I mean, it's a little bit of an interesting debate, right? Some of these provisions are intending to prevent the accumulation of super large balances. And then you have this large balance RMD on the back end. So it almost seems like we don't need both sides of the equation, right? Seems, very effective to just, if somebody does happen to, say, hit the investment return jackpot, get the large balance, say, congratulations, and now the government gets half.
Yeah, absolutely. Let's move on to the next quick hit, which is the IRS retirement plan limits that we just were so grateful to have released.
So, speaking of how much one can contribute to a retirement plan through various features, the numbers are broadly going up next year. 402G limit for pre-tax and Roth contributions going up to 20,500. That's the core limit, not the backdoor. Catch-up contributions are not changing, still $6,500 for those age 50 or older anytime during 2022. That 415 limit, the total annual additions limit, is often overlooked but important to understand for that mega backdoor Roth strategy. That is where those after tax contributions are considered. So, this is the total of new benefits that can be earned in a plan. It's going to include the 20,500. Also would include any company contributions, whether that's matching contributions, profit sharing, non-elective contributions, etc. But any amount that remains after all those contributions could be filled with after-tax contributions and also then Roth conversions. Compensation that can be considered under the plan is definitely notable as well. That is going up to $305,000. That's for purposes of calculating benefits provided under the plan.
All right. Next quick hit to discuss is the Department of Labor's ESG guidelines that they're, I guess, are proposing, right?
We are still talking about ESG regulations. I feel like we've talked about this a lot in the last year, but there have been a lot of shifts and changes. This one really not a surprise. The current regulation that is in place was a very late action from the Trump administration. It was finalized last fall. Earlier this year, the Biden administration announced that they wouldn't be enforcing the current regulation, so not a surprise to have them then come back and put in place their own regulation.
So let's talk about the regulation.
Yeah, so essentially what the new regulation is saying is just walking back or forward, maybe is a better way to think about it, from what the Trump administration did. What the Trump administration said that was that when fiduciaries are selecting investments for a defined contribution plan, they should only be considering factors that impact financial results. We call those pecuniary factors. This regulation, as proposed, is saying, well, social factors could impact financial performance and results, and therefore can and may be appropriately considered as part of evaluating investment options.
So can you give us an example of what the proposed regulation would mean for fiduciaries when selecting investments?
Well, I guess it depends on your point of view. Our opinion is it doesn't really matter a whole lot. At the end of the day, fiduciaries are still held responsible for acting prudently, acting in participant best interest, ensuring that fees are reasonable. Our opinion of the Trump administration regulation, and I think this one too, is there are socially responsible investment strategies that can meet prudent investment standards, that are going to have competitive performance, that have reasonable fees. And so there's plenty of room for fiduciaries who want to offer an ESG option to do so. Whether the needle has moved slightly with these regulations, from our perspective, doesn't make a huge difference.
And what is have companies basically how have they been handling this push for ESG?
Well, I think the first question to really think about is there a push for ESG? Who's pushing for ESG? Is there a push? We have definitely had a number of clients who have heard requests from participants. And in those instances, we're encouraging first the fiduciaries to kind of participate in some education, let them learn what are ESG investment strategies, what does the marketplace look like, what would this look and feel like in a defined contribution plan, and talk about, is this an appropriate investment strategy or not? We've also had a number of clients that have said, it's just, we're not hearing about it from our participants. We're not interested in it. So, no need to go through that process.
All right, so give us some perspective on what actions companies are taking. Like, are they adding funds to their core menu? Are they encouraging exploring it through a brokerage window, or are they just saying Too bad, so sad. Do it in your
You know,
personal account.
so going into this year, right around 15% of plans reporting that they're offering an ESG investment option to participants. We're definitely going to see that number increase because there's a ton more conversation here. And as we'll talk about in our deep dive, there's a lot of product and just a lot of focus. But we're not seeing this or expecting to see this become a new standard type of option. The number is going to increase from 15%. Maybe it goes up to 20% over the next couple years. Maybe it goes up to 25% because sometimes in the self reported data, we see people say, oh, yeah, I offer that. But we're not expecting to see a lot of companies offer that. And that's been our experience with the conversations we've had. We've had some clients that have felt that it's really important to them from a benefit perspective to offer that choice to their employees. We've had other companies that have looked at it and said, there's a lot of development happening in this marketplace. It's not the right time. We've had other clients and committees that have said, we offer a range of choices already, and this could open up a whole loophole and wormhole into a lot of different types of strategies that we're just not interested in offering in the core menu.
And we're going to take a deep dive this month on ESG and sort of address a lot of those things you just mentioned and a lot of the scrutiny that is going on in the space. So if you want to stay tuned for that, maybe give people a preview of what we're going to cover in that deep dive.
Yeah, so we want to spend a little bit of time just sharing some perspective on the marketplace for ESG investments, including what is an ESG investment strategy? What do they look and feel like? How has the market grown? Because it really has grown quite a bit, but it's also not really a dominating market relative to the broad universe of products out there. And talking a little bit about some of the considerations. What are some of the things to be cognizant of when evaluating an ESG investment strategy, whether that's for a retirement plan or just relative to the universe of available investments?
Awesome. So stay tuned for that if you want to learn more. Let's move on to another quick hit, the new audit rules that are coming out. Audit rules are, I think it's a long time coming, and we're going to get some new rules here. So preview for the audience what we're expecting to see here.
Well, you're definitely not kidding with it being a long time in coming. This is actually, I think, coming from a government accountability report that happened all the way back in 2010 that pretty much said retirement plan audits are not particularly useful and the quality is very
Sure are.
poor. Um, the new rules were actually published back in 2019. They would have been effective last year if not for COVID, and they were delayed 2 years. So, in some respects, I think this hasn't gotten as much headline as perhaps otherwise it would have. But it will be effective for plan year ends after December 15th of this year. So, looking at the plan year 2021 audit, I think a lot of companies are potentially going to be surprised when they're looking at more stringent requirements and probably some additional cost that goes along with that.
I'm always surprised that in all of our years of doing this, we have very few, probably count 'em on one hand, instances where an audit has actually caught an administrative error. And compared to the administrative errors we catch in working with
Yeah,
clients, it's
I
just
think we catch more audit
unbelievable.
errors than auditors catch administrative errors, but that's a whole separate topic.
Yeah, that's a
No,
good
and
one.
I think that's part of even the reason for these standards, and something that has been observed in the industry is there's such a wide range of approaches and considerations in these audits. On some levels, it's not necessarily unreasonable to approach this primarily as a financial audit, whereas other auditors really do dig in more deeply on administration, compliance, and some of those
Right.
ongoing processes. So that's a little bit of what they're trying to correct for here or adjust. I think one of the biggest things that's going to shift from an outcomes perspective, as a lot of folks may be aware, the most predominant type of audit, most of the type of audit most of our clients have currently or in prior years is called a limited scope audit. What that means is that the auditors are not validating they're not auditing the investments themselves. So when, the reporting says that the plan has, 100 shares of the Fidelity 500 index and the price of that index, they are accepting that. That is because it's reported on a certified trust report. And so they can take that certification and therefore not audit those numbers.
Yeah.
So there's going to be a little bit of a shift there. The name that has been put out by the AICPA is that they will now call that an ERISA Section 103A3C audit. Got to think they're going to come up with a shorter name for that at some point. But they're actually going to require the plan administrator, plan fiduciary, to validate affirmatively in writing, yes, we qualify for this kind of audit. They're going to be asking a lot more questions, and they're actually going to be issuing an opinion. That may sound kind of funny. A lot of folks don't necessarily realize or appreciate. Previously, the auditors really weren't issuing an opinion. It was just said there's no opinion because we didn't audit a lot of the data. That's no longer going to be the case. The auditor is going to have to opine on the quality of the data that they don't audit. Does it seem to be accurate and complete? And then they are going to be looking at other things beyond the trust report and need to comment on those.
Yeah, I think I have a name for it, what they're going to call it. It's going to be called the more expensive audit because it's going to cost a lot more money. And I think our clients need to be prepared for that fact that these audits are going to become a lot more costlier in the future. Number one. Number two, they're probably going to involve a lot more time from our corporate staff to support the audits.
Yes, that's something we'll definitely be working with our clients on in the first half of 2022 is, how do we get with the auditors in advance so that we're not caught off guard by any new requirements? Do you think some auditors have started to work in a higher degree of rigor? So for some companies, it may not seem like quite as extreme of a change, but nobody wants to be caught by surprise in, September of next year when time is running short with a very comprehensive audit requirement.
And do you think there will be sort of a cap on the size of plans that need this deeper audit, or will it be everybody?
Nope, it applies to anybody unless you're not required to have an audit at all, which, that requirement kicks in once you've got 100 participants in the plan.
And so this could be a significant expense for smaller plans to incur. Do you think it'll deter companies from offering plans?
It potentially could. That's one reason why the pooled employer plans or PEPs are growing as an option. It's a new option. And part of the idea is, you are kind of taking a step back from that audit requirement that's being done across companies. Now, there's other reasons why a PEP may not be the most cost efficient or resource efficient way to offer a plan. So it'll be interesting to see, hopefully audit partners will be understanding of, rolling out these new requirements in a way that doesn't put themselves out of business.
And I think one of the ways we're going to support our clients is by issuing an audit survey to help them identify what fees look like